Another big one we run into is insurance. Everybody wants to file an insurance claim. Master policies for insurance, for condo associations, the deductible is like $10,000. So the first $10,000, the association is going to pay for out of reserves or out of their operating budget to begin with. And then every year the insurance company is going to do a loss run and see how much money they paid out to that association over the year. And all the insurance companies have access to that. So what they will find is that complexes that start putting in a number of insurance claims, one of three things will happen. Either one, their insurance premium will go up substantially for the next year, which is already one of the biggest expenses for an HOA, is the master policy expense. We have an association that I believe is 66 units, and they pay $50,000 a year for their policy, plus $10,000 deductible if they ever use it. And each year that goes up substantially, especially if you're putting claims onto that insurance company. In addition to that, the insurance company can choose not to renew, and the HOA, if they've had a lot of losses or a lot of claims, no standard insurance company will insure them. So they'll have to go to a secondary market where rates are exorbitantly higher, or no insurance company will insure them, in which case they'll have to be self-insured, and anything that goes wrong will come out of the unit owner's pockets essentially, and really putting the association at risk for bankruptcy if something major catastrophic happens. So every time something little happens and the first instinct is to send it to the insurance company, we really advise our clients to think twice or three times before doing that, because yes, the insurance company might pay for it in the short term, but the implications at 2, 3, 4, 5 years down the road can be catastrophic to an association that is just putting claims into the insurance company at every turn. And so we advise against that, and ultimately the one thing that we try to get across to ownership is the idea that the financials, it's not like when the HOA pays for it, it's some other entity paying for it and they don't have to worry about it. It's not coming out of their pocket. It is coming out of their pocket. It's coming out of everybody's pocket. And what they're going to find is that the more stuff they want the HOA to pay for, that's okay, but they should also expect their HOA dues to go up. And those things that the HOA is paying for have to be able to be unilaterally enforced, right? It has to benefit all of the ownership, or at least the majority of the ownership in a common interest community. You can't just be paying for stuff that really only benefits one or a few condo owners or unit owners. So that's how the nuances of how the financials in an HOA work.